your long-term investments are still growing, but they feel less protective than they used to. The numbers rise, yet the sense of security doesn't rise with them. Something has shifted, not in the market's direction, in its structure. Long-term investing was supposed to reduce uncertainty. That was the logic. Time smooths volatility. Patience absorbs shocks. Diversification spreads risk. Intelligent people trust this because historically, it worked. Staying invested felt responsible, disciplined, rational. And for years, the reward for endurance seemed consistent. The longer you stayed in, the safer you became. But recently, the feeling has reversed. Time no longer feels like protection. It feels like exposure. The visible effect is subtle. Portfolios recover from declines, but recoveries feel thinner. Gains arrive, yet they feel conditional. Each rally carries a quiet fragility. News cycles move faster. Reversals happen without warning. Even diversified positions swing together. You notice the volatility. But what unsettles you is not movement. It is how little control movement seems to offer. Beneath that effect sits an invisible mechanism. Markets are no longer driven only by earnings, productivity, or long-term expansion. They are shaped by liquidity cycles, policy responses, and concentrated capital flows. When liquidity expands, everything rises together. When it contracts, everything tightens at once. Diversification still exists on paper. But structurally, many assets now respond to the same pressure. The safety that once came from separation now operates inside a shared system. Investors respond the only way they know how. They extend their horizon further. They repeat the principle, stay invested. They double down on patience. Because stepping out feels like timing the market, and timing the market feels reckless. So they remain inside the structure. They add during dips. They hold through rallies. They follow the discipline that once created confidence. But discipline inside a changing system does not produce the same outcome as discipline inside a stable one. Over time, this becomes a behavioral trap. The more uncertain the environment feels, the more rigid the strategy becomes. Investors cling tighter to long-term frameworks precisely because conditions feel unstable. That rigidity feels responsible, but it reduces flexibility. Selling feels dangerous. Rotating feels unnecessary. Holding feels safest. So exposure quietly concentrates in the very system creating the uncertainty. The structural lock-in deepens gradually. Retirement accounts are tax-advantaged but restricted. Capital gains create friction to reallocating. Employer matches anchor contributions into specific vehicles. Automated investments continue without reconsideration. None of these are mistakes, they are efficient. But efficiency reduces optionality. The longer capital remains embedded in one structure, the more costly movement becomes. What once felt like freedom through automation becomes commitment through design. This is where uncertainty changes shape. It is no longer about short-term market swings. It becomes uncertainty about the system itself. If liquidity is the hidden driver, then valuations are less about intrinsic strength and more about external support. If policy can alter asset prices quickly, then time does not eliminate risk. It transfers it forward. The risk is not that markets decline. The risk is that the rules shift while you remain fully allocated. Long-term investors sense this without naming it. They read headlines about debt levels, rate changes, geopolitical shifts. They see markets react instantly. They notice that correlations increase during stress. They feel the compression of options when everything moves together. Yet they continue investing because stopping would feel like abandoning the only framework that has ever worked. This creates an identity collision. Long-term investors see themselves as disciplined, rational, steady. They avoided speculation. They ignored noise. They followed financial advice built on decades of data. They saved consistently. They diversified responsibly. And now, despite doing everything correctly, uncertainty has increased instead of decreased. The system is no longer delivering the emotional stability it once promised. Recognition emerges slowly. The strategy has not failed. The environment has changed. Long-term investing assumed expanding growth. stable policy direction, and clear capital allocation signals. But when growth slows, policy intervenes more aggressively. When debt expands, rates become structural tools rather than neutral forces. When capital concentrates, market leadership narrows. The framework still functions, but its protective power weakens. The point of no return is subtle. Time has already been committed. Decades of contributions sit inside structures optimized for continuation. Exiting would trigger taxes, penalties, or opportunity cost. Reducing exposure feels like sacrificing long-term compounding. Increasing exposure feels like embracing higher fragility. Either direction carries consequence, so most remain still. Not because they are confident, because movement has become expensive. This is the quiet shock. Uncertainty is no longer about where prices will go next quarter. It is about whether the architecture supporting those prices will behave as expected over the next decade. Long-term investors are not afraid of volatility. They are uneasy about dependency. Dependency on liquidity, dependency on policy stability, dependency on collective belief in perpetual expansion. And yet, portfolios continue rising during favorable cycles. Statements show growth. Accounts compound. From the outside, nothing appears broken. That is what makes the feeling difficult to explain. The system is functioning, but the confidence that once accompanied participation has thinned. Because the deeper realization is this: long-term investing does not remove systemic risk. It assumes systemic continuity. It assumes that over time, structures remain intact. But when structures themselves evolve under pressure, time can amplify exposure instead of dilute it. Investors sense they are part of something larger than a portfolio. They are embedded in a global capital network shaped by forces beyond earnings reports. Liquidity flows across borders instantly. Policy decisions ripple through every asset class. Passive funds allocate capital automatically. Price discovery becomes intertwined with momentum. Staying invested means remaining connected to all of it. And connection has weight. The longer you remain connected, the more your financial future depends on the stability of systems you cannot influence. That dependence does not announce itself dramatically. It accumulates quietly, alongside your gains. This is why the uncertainty feels different. It is not panic, it is awareness. Awareness that compounding relies on more than patience. It relies on structures that must continue functioning as designed. And structures, unlike individual companies, can shift in ways that historical charts never captured. So long-term investors keep contributing, they keep holding, they keep trusting the process that once reduced anxiety. But beneath that trust sits a new question. Not whether markets will rise, but whether the conditions that allowed them to rise in the past will remain stable enough to justify the same level of faith. The answer does not arrive in a single downturn or a single rally. It unfolds slowly through policy shifts, capital concentration, and subtle changes in market behavior. Each shift is manageable. Each adjustment appears rational. But together, they reshape the landscape long-term investors believed was fixed. Your investments may continue growing. Your statements may continue reflecting progress. But the feeling of certainty has already changed. And once certainty changes, participation feels different. Not because the strategy disappeared, because the system surrounding it did. If you're interested in how money, incentives, and behavior really interact, you may want to follow Finance Simplified.